Welcome into Storm Stock Solutions. I'm Grant Mercer. The opening bell is on deck, and our job right now is to bring some clarity to the chaos before the market gets going. Let's start with the big forces in play this morning. On the macro side, Mark Hulbert over at MarketWatch has a timely reminder that Wall Street forecasts are notoriously hit or miss, especially around inflation and rates. His piece highlights how markets lean on instruments like inflation-linked securities to see the future of price pressures better than pundits do. The takeaway for traders: expectations for future inflation, not just today's CPI print, are still a key driver for valuations in growth, tech, and anything with long-duration cash flows. Layered on top of that is a deeper story about the consumer. Jeff Ferry, also at MarketWatch, points to what he calls America's unaffordability 5: housing, food, healthcare, childcare, and energy. Those costs have been climbing for years, long before the latest tariff debates, and that structural squeeze on household budgets hangs over everything from retail to financials. So even if headline inflation moderates, the street is asking, how much real spending power does the consumer actually have? Now, zooming into today's key drivers and headlines. One of the big single-stock stories is Oracle. According to reporting from Emily Berry at MarketWatch, sentiment around Oracle has quickly deteriorated, with investors worried about financing needs and the near-term AI expenditure. The upcoming earnings report becomes a mood test. Does management calm nerves by showing those financing demands are less intense than feared? Or do they validate the caution? That call is likely to reverberate across legacy software and AI-adjacent names. There's also a forward-looking warning from strategist Warren Pies, highlighted by Barbara Kohlmeyer. He's flagging the risk of an optimism shakeout in early 2026, essentially that AI enthusiasm and broad market optimism may need a reset before the next leg higher. For today's trade, that kind of narrative can act as a speed governor on risk appetite, especially in the more stretched AI and tech leaders. On the opportunity and strength side, the consumer is sending some mixed but powerful signals. Weston Blasi reports that Americans are on track to spend a record $20 billion using buy now, pay later options this holiday season, with Black Friday and Cyber Monday seeing historic usage. That dynamic is front and center for traders watching BNPL platforms, fintech rails, and e-commerce players. Strong volumes can be a tailwind for those ecosystems, but they also raise questions about credit quality and whether we're pulling forward demand from 2026 into this year's holiday rush. We're also seeing some notable strength in discount retail. Tommy Kilgore's piece on Dollar General points to rising customer traffic and better-than-expected sales, with the company grabbing market share even as one of its key rivals, Dollar Tree, struggled. That's the classic trade-down story. In a tight affordability environment, value chains can see more foot traffic. Traders this morning are likely to be watching the broader low-price retail space to see if this is stock-specific execution or a wider shift in consumer behavior. On the flip side, there are some areas to handle with care. The job market headline from Jeffrey Bartash is counterintuitive at first glance. Jobless claims have dropped to a 3-year low in what he calls a no hire, no fire U.S. economy. Businesses are avoiding layoffs, but also freezing hiring. That can be a tricky setup. For markets, extremely low claims can remind investors that the labor market is still tight, which can pressure rate cut hopes. At the same time, a freeze in hiring could cap wage growth and consumer confidence down the road. That push and pull is something rate-sensitive sectors and cyclicals will be watching closely through the session. Let's talk about a couple of under-the-radar stories that could matter more as the day develops. Mike Hoffman's piece digs into how some CEOs may be using AI as cover for broader management missteps, spending heavily on AI infrastructure that never gets fully utilized, then turning to layoffs to mask those decisions. As AI becomes the buzzword on every earnings call, traders may start to differentiate between companies with genuine productivity gains and those simply name-dropping AI while cutting costs. That's a theme I'm watching in the background, especially across enterprise software, cloud, and its services. Staying with AI, Christine Jiai's coverage of Microsoft's relationship with OpenAI makes a key point. By structuring the partnership the way it has, Microsoft may have offloaded a lot of the operational and governance risk while keeping a big share of them. The upside, some analysts are calling that a kind of safety net for the stock as the AI cycle matures. If volatility picks up around pure-play AI names, investors may continue to favor platforms like Microsoft that sit closer to the infrastructure and away from single-product risk. That's not a call to buy or sell, just a framework professionals are watching as they think about where AI risk really sits. Stepping back, today's tape sets up as a tug-of-war between resilient headline data and underlying affordability strains, between AI optimism and the possibility of an eventual shakeout. Traders will be watching Oracle's tone on earnings, the behavior of BNPL and holiday retail plays, and any shift in expectations for inflation and the labor market as more data and commentary hit the screens. I'll be back with intraday updates once the market opens to track how these themes actually show up in price action and where leadership and stress are emerging. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer. Stay sharp, stay steady,